I am excited to introduce our first panel. And we're going to be sort of talking about how to accelerate development finance amid this moment of financial disruption. So I will introduce Simon Meldrum, who's the co-founder of the Humanitarian Finance Forum, Michael Anderson, who's the CEO of MedAccess, and Juan Luis Coderca Gallego, who is the head of new financing models at ICRC. Thank you all for joining us. I'll also mention that we had hoped that Amanda Glassman from the Center of Global Development would join us today, and unfortunately she was unable to make it at the last minute. But I am confident that we're going to have a really great discussion here for all of you. I wanted to start this panel perhaps by just doing a quick check of who's in the audience with us. So if you work for a private company, can you raise your hand? If you work for an NGO, can you raise your hand? If you work for government? just a couple? If you're an investor or someone who raises or deploys capital, can you raise your hand? Great. Thank you, guys. So I talked a little bit about this moment that we find ourselves in. It's a bit of a challenging moment. I'm hoping that you guys can help us sort of understand what is sort of the state of development finance and what are some of the headwinds that we're seeing at the moment that are going to have to be overcome to really both address these challenges and move the field forward as a whole.
Yeah, right, me first. Wow. Welcome, everybody, and thank you for asking me to come and speak. It's really wonderful to share the floor with people, and it'll be great to get views, because we certainly don't have the answers. I certainly don't to those huge questions. And it's great to see a pretty broad cross-section of people, because it's really, I think, it will take everybody to do things much more radically differently than has been done in the past as we set this scene and try and address these challenges. My background is in banking and finance and debt capital markets, and then I got involved in social investing with a UK focus first and joined the Red Cross in 2018 as part of what we call innovative finance. And I sit with IFRC and work quite closely with Juan. I think it's not just the economic challenges, right, and the humanitarian funding gap that people are quite familiar with that is a challenge. Of course, I mean, that was before COVID, that was before Ukraine, and before the British government, reduced its commitment to zero by 0.2. So, I mean, I think those economic challenges that you highlight are well. It's also the political economy, right, is very significantly changing. The world in which these kind of models that we had developed, or development finance, of multilateralism, is also, facing increasing challenges in cooperation. And I think they're things we need to recognize. And I think in order to start to move forward, we need to recognize the reality, I mean, very sobering that it is, and really engender ourselves to think much more boldly than we have and much more radically than we have, right? And I think, and my last comment would be, I think, what I've said so far is probably well known by people, but from my background, what I've seen is there isn't the will or the technical expertise to really start to address these kind of challenges at the scale that they need to be addressed. And I think there's models out there that we've worked on, and that are very effective. I think, but aren't being promoted or developed or evolved quickly enough. One that I would particularly kind of reference there is IFM, right? The IFM model, which supports Gavi's vaccine program. I mean, I think that's a tremendous success. Established in 2006, it's now issued 10 billion of bonds, right, and enabled Gavi to do things. But that hasn't been, there's technical reasons why that hasn't been replicated, but I think people haven't looked at the model as an example to use how you could move things forward like that. So I guess I'll stop there by saying, yeah, it's very sobering. We need to be really reflective and think that there's, more radical in our approaches. There's too much incrementalism, I think, in what's being done, and not enough realism.
So I'd like to look at the balance sheet of how do we mobilize going forward. On the plus side, we have an efflorescence of talent and entrepreneurship and attention and energy. We also have financing flowing into low and middle income countries, private financing in a way that is utterly unprecedented. When I was in my 20s, we wouldn't have had a gathering like this that included investors and business people, because it was mainly government and aid people. So that is fundamentally transformed. And we have new tools, some of which we're going to talk about, new tools for innovative finance and so on. But we also have really substantial momentum forward in development of human capital and so on. So there's a lot of stuff on the positive side. On the negative side, we are really entering some choppy waters economically. And not just the next few years, which I think are going to be very choppy, but for the long run. And I've picked out 5 C's that I think are a problem at the moment. There's COVID and the aftermaths of COVID, about which they're both economic and social and health. There's a big health burden left over from COVID. Conflict, not only Ukraine, but local conflicts and ongoing conflicts, a lot of which Juan and others deal with. Climate change. Climate change is going to continue to be a permanent drag on, but also opportunities. Contracting economies, that's the piece I want to talk about the most in a second. So the economies that have pulled in because of commodity prices and fuel prices, energy prices, declining growth. And the last one isn't really a C, but I'd really be grateful if anyone could think of a C for me. I've called it closing of bilateral aid opportunities. That there's been a big reallocation of bilateral aid towards Ukraine, especially refugees and other areas. So can I just quickly summarize very fast what the IMF said recently? So 2 weeks ago, the IMF issued its new economic outlook for sub-Saharan Africa. And this is only sub-Saharan Africa. It's not everywhere else. But I think it's really telling. So they picked out a handful of things. One is growth. The growth projections are way down for Africa. Africa recovered 4.7% growth in 2021, recovering from COVID. But they're looking at a projection of 3.6% growth next year, and with some really substantial downside risks, the chance that it might go south of zero. And there are a bunch of reasons for that we can talk about. The sharp rise in inflation. Third, the monetary tightening. This is a really big thing happening in the global economy. So we've seen the tightening, monetary tightening, especially in the U.S., but other big trade currencies. So of the 35 low-income countries in sub-Saharan Africa, at the moment, 19 of those 35 are categorized by the IMF as in debt distress, or just on the verge of debt distress. And that has to do with which IMF programs they're accessing. So that means the IMF has concluded that overall debt levels are approaching those previously seen in the early 2000s, before the HIPC initiative. So nothing that we have seen recently in terms of overall debt. And there's a really important development in that, which is that the composition of the debt, which used to be mainly bilateral debt and multilateral debt, the composition of the debt has now enormously expanded to private domestic debt. And so a lot of it's in local currencies, which means that the private domestic debt rose from about 10% of GDP in 2000 across sub-Saharan Africa to over 30% now. And bilateral debt has dropped from what was previously 20% 20 years ago, down to about 4%. So,
and that definitely, and we'll have a discussion later today specifically about debt. But I think a big part of what that's done is also made working out the debt distress remedies much more difficult. And it means a different set of players need to be at the table. And I think if you look at, the common framework on debt treatments that came out of the G20, which has been very slow to make any progress. It's been very hard to get private sector engagement there. So I think one of the things that will be critical will also be looking ahead to how do you get those private actors engaged in a different way. I think, I've been having some interesting conversations where I think there could be opportunities, given some of those bond prices are actually trading quite low right now, to figure out how could you do a debt for climate, a debt for SDG swap, where you would get them to take something of a haircut, but not as great as what the current bonds are trading at. And so I think maybe we can talk about, some of these. Is that a place where, innovation, and we do have some models where we've seen similar things happen in the past, could be used? Does there need to be another HIPC, which was heavily indebted poor countries initiative, if I'm getting the acronym correctly, but it was a World Bank initiative to help bring down indebtedness in the 2000s. Juan, let's go to you.
Right. So I do work for the International Committee of the Red Cross, the ICRC. So conflict environment is our setting. So if we're discussing about development finance, we're going to be looking at it from the point of view of fragility and of enabling more development finance to be deployed in the countries where the ICRC works. Now, I think what's interesting, this may seem marginal for the conversation, development finance applied in fragile settings, but it's not. According to the projections of the World Bank, more than 50% of the poorest of the poor will live in protracted conflict situations around 2030. So this is not a minor conversation. It is a critical one. The counterpoint being that conflict environments are more complex and difficult for development finance. However, one thing that needs to be underlined, or another thing that needs to be underlined, is that most multilateral development banks and a good number of national development banks have been developing strategies to deploy their firepower in FCV settings, or fragility, conflict, and violence settings. And for those who may have noticed, the European Investment Bank was the very latest to do so just a few days ago. The ICRC has been developing partnerships with a number of these multilateral development banks, and other members of the Red Cross have as well. That includes the World Bank, the l'Agence Française de Développement, GIZ, the Dutch Invest International, USAID, and others. We have proofs of concept and strategic partnership, about which I'm happy to elaborate a bit more during the conversation. The key point, and I will stop with that I would make, is that we look at innovative finance as families of mechanisms that actually enable collaboration between actors like the humanitarian actors like the ICRC, the Red Cross, development actors, but also private sector, local actors, in such a way that projects that would not take place become viable thanks to our intervention and thanks to the deployment of innovative financing mechanisms.
So I think that sort of sets us up perfectly, because I think what we should talk about is what are some of those mechanisms? What are some of those solutions that can be tested and then scaled to address some of these challenges and gaps that we're seeing in our world? And Juan, I think one of the things you're doing that's quite interesting is there's been a lot of discussion for many years about this sort of humanitarian development nexus, right? The World Humanitarian Forum, I don't remember, like 6-7 years ago now, this was like a huge thing. We need to figure out how to do this better, to have more collaboration. And I think it still presents a challenge, but I think you guys are thinking about this in creative ways. And I think it would be interesting to hear more about the work you're doing in DRC, where you're really looking at how do you address what is a protracted humanitarian crisis in a way that can bring in maybe different types of capital than you would have traditionally raised, but also sort of set things up for a long-term development trajectory.
So happy to, thanks. I would indeed also underline the fact that nexus can be a bit politically charged. So we prefer to speak about more sustainable humanitarian impact, or solutions that look at exit strategies, making sure that whatever it is that we were doing, is solid and sustainable, including financially sustainable where that's possible. So let me give you an example. The ICRC has been working in DRC, so the Democratic Republic of the Congo, for 45 years. We've been in Goma, in the eastern side of Congo, for 35 years. We've been working in water in Goma for 30 years. A few years ago, in 2016, our colleagues in the water teams decided they were just dead tired of coming up with short-term limited solutions to water issues in Goma. And the big problem was that the city had been expanding for years due to conflict, due to the IDPs that were coming, refugees, natural growth, etc. And there was no water infrastructure. So our colleagues came up with a master plan for water in West Goma to 2030. That was an investment on our part. We put it on the table with some of our humanitarian donors. The response was, this is too long term, this is too big, this is too complex, we're not helping you with this. Internally, it was too big for our budgets, and it was also too complex. So this project landed on my desk immediately after we had launched the humanitarian impact bond. Yeah? So I had a network of partners, including Munich Re, Lombard Odier, DFID at the time, the Swiss Development Agency. We also included the World Bank. We put it on the table and said, hey, can we look at this together? And there was interest immediately to look at it together. And our principal were thinking, okay, we're going to do another impact bond. Yeah, we did think that way. That's not what we're thinking now. Where do we stand today? Today, we stand with a model that is based on innovative approaches to blended finance, whereby we have mobilized some humanitarian funding for the ICRC to take the project far enough for development actors to come in, to work on the legal frameworks, to develop the local capacity, and to pave the way for a private operator farther down the road. This also means that what we thought at first like a 40 million Swiss francs or euros or pounds or yeah, we're on a par just everywhere. What we thought it was going to be a 40 million program that we were going to shoulder, project that we were going to have to shoulder. Right now, there's 2/3 or 3/4 of the project that have been taken on by development actors who are deploying their development finance directly with local actors. So maybe just to wrap up on this point, because this model is totally replicable, and we actually have a number of projects in other places and also in DRC that are coming up bottom up, but also support some intentions of support from development actors, is that at the beginning of the conversation about innovative finance a few years ago, the core objective was, let's fundraise for ourselves. That logic doesn't work. You want to do innovative finance or development finance applied to more fragile settings, which is also another way of looking at innovative finance. You need to start with the problem, and you need to look at innovative finance solutions as a series of means that enable partnerships across sectors, across the humanitarian, development, private, local sectors, in such a way that you make the project viable.
Thanks. I mean, I think one of the things that strikes me about that is that you can truck water into communities to ensure access for decades. Or you can do what you guys are trying to do, which is actually build the infrastructure which could far outlast that, and in the end should actually be financially more sustainable.
Sorry, if I may just add, because this is also part of the innovation in what we're trying to do, is that this is about building the infrastructure, but also a financially sustainable operating model. There's cash flow once the infrastructure is built, and there is an objective across among the partners to pave the way for a private sector operator. This is a totally new thinking for humanitarian actors like the ICRC.
Simon, I wonder if we could come to you, because you run the Humanitarian Finance Forum, and I think you think a lot about how do we sort of bridge the understanding gap, that knowledge gap. What type of tools do you think can work? Is that type of project scalable? What does it take to get that to a place where a private operator might come in?
Yeah, thank you. Yeah, and the forum is something I set up with IFM too, and please do, if you think it's relevant to you, Luck, and join and participate in the discussion. And really, it's a platform to bring cross-sector together, to recognize what Juan is saying, that actually, the development humanitarian nexus or this separation doesn't work on lots of different levels, right? One, if you actually care about impact, it's asinine to describe things as humanitarian or development. Very practically, I've sat in rooms where people debate. I mean, from my background, I've had serious debates or whether a tap is a humanitarian or a development tool, right? That's the consequence. Yeah, but I mean, it is funny, so I use it, but I mean, it's very profound to think about that, right? So that has to change. The other thing is, if we talk about development as a humanitarian side, it's also very simplistic to think, as Juan had illustrated, that humanitarian are short-term needs. There are emergency response, but ultimately refugee camps, things like Goma, are multi-year. And again, it's a terrible indictment of the system where these real needs are being addressed badly by short-term intervention. So that has to change. And equally, on the development side, right, when we talk about green and climate, one of my things is, the people who are being affected now, the billion people affected by climate change now, are the most vulnerable in the most vulnerable context. And that's a humanitarian issue first and foremost. So I think that's and that needs to be understood by development and the broader piece. If you don't have, it's very, it's all well and good to talk about climate, but if you're not thinking about or addressing how that's impacting vulnerable people now and today, you're missing a big gap. And as Juan had said, so I think these things need to be recognized. Also, I think to get to scale, one, you need to think about scalable challenge, operating at scale to address these huge needs, as Michael was saying. And two, you need to think about sustainable interventions, the financing being sustainable, right? Because that's the only way you'll attract private capital. Otherwise, the capital, whether it's private or public, will erode over time. So then the question becomes, what are you willing, what are you prepared, what are you able to do to bring in the private capital that can be deployed in these kinds of contexts, right? And I think that's a much more constructive debate about doing it. And then very simply, as someone who kind of works in finance, I think, we mix up all the time in these communities the two of funding and financing. Are we talking about funding, okay, which is effectively an income stream, okay, and not replaceable? Or are you talking about financing, which is ultimately something that is replaced or income stream, right? What I mean by that is, if you go to a bank and ask, can I have some money, can I have some financing to buy a house? They'll lend you the money if you have a job. Okay, if you don't have a job, you don't go to the bank, it's very obvious, and ask, can I have some money to subsidize my income? And yet vast swathes of people, and I'm sure some in this room, think it's completely acceptable to go, I've lost income, I don't have grant funding, I'd like some financing. That's not an investable proposition, and that's not a sustainable proposition, right? Sustaining something means returning the cost of capital, and then you get into a debate, about what's an acceptable return, what's an appropriate return in cost of capital. Is it a good use of public funds to subsidize returns on capital to private investment and you need to be able to justify that and demonstrate it. But I think so. That's some of the tools. I mean, and then I'd like to make one last point about the. So I think it really, about the forum, and it's that kind of approach. We have global challenges that are huge and growing enormously. We need to put people and the humanitarian issues at the forefront, and it absolutely is imperative that it's much more cross-sector when we bring people together to have much more practical solutions and approaches, working on real projects like Goma or others, in these kind of various forms, because I think a lot of this is probably, there's a reasonable consensus about what I'm speaking about.
But we need more sort of practical examples and
we need to
concrete, scalable,
I mean, my little favorite
tools.
example, and if people have heard me talk, they'll have heard this before, right? So, some of the numbers talking about it, and what is scale, Jane, the impact investing, there's a trillion assets, right, ESG, in impact investing globally is their estimation, okay? And we talk about impact bonds, right? Now, impact bonds, the Brookings Institute, impact bonds by the numbers is my favorite go-to reference of their website, October. There's been about 500 million of impact bonds, which is, a very significant contribution, right? But of that, and in 38 countries, okay, but only 17 have been done in development impact bonds. Let's be realistic. The average size of an impact bond is 3 million. The average people served is 18,000 people. 50% of impact bonds serve less than 500 beneficiaries. That's really important, and they make significant contributions. But it's not right to talk about impact bonds and how do we scale them, because if they were scalable, they would have been scaled already, okay? I'll repeat that. If impact bonds were scalable, they would have scaled already, and over the same kind of time, I mentioned IFM. We also have green bonds. They started in 2007. European Investment Bank, or EBRD, vie for the title. That was the first one. It was in 2007, 150 million euro issue. Okay, so we can make the parallel. Now green bonds are 500 billion a year. Okay, this is much more difficult to do, and the analogy is imperfect, but that's scale, and that's where the ambition should be. And then I think the ambition, needs to be much higher, but we need to also understand this is much more difficult and complicated than just kind of talking about it and workshopping.
To follow up on your point,
yeah.
I think one of the things that allowed green bonds to scale in the way that they have is that it was a very familiar financial instrument for commercial markets. It was something they could understand. It had an additional layer. The money has to be spent in XYZ way. And there's a whole nother debate we could probably have about whether there's true authenticity behind what percentage of that green bond market, whereas development impact bonds, are often quite bespoke transactions, and they're not actually bonds, right?
Correct.
So it's a bit of a misnomer, their name. We could maybe more accurately call them results-based contracting mechanisms, which is also a mouthful. And but I do think that is perhaps a part of it. And so one of the things I've been thinking about lately is how do you think about what role each instrument can play? Because if you talk to organizations involved in development impact bonds, transformational for the organization doing them in the way they manage data, in the way that they can better serve the people who they're working with. So maybe there is a role for them, but the role might not be in creating that bridge to more commercial capital.
Yeah, absolutely. I mean, impact bonds have been 500 million is a significant amount of money, right? And have made tremendous difference to the people served. That's not at all to denigrate them, but they don't achieve scale. Yeah. That's the point. And can we move on from the discussion of how do we scale impact bonds, right? That's not
to figure out what are the other instruments for scale,
right.
And they could be a part of the broader development finance
absolutely.
discussion, as long as they're used for the appropriate purpose.
Right, and I think I'll just say one last point on, I guess what I was trying to do with the forum and setting it up and get it going is, the job of finance people is to work at finance. The job of humanitarian actors or organizations is to articulate what they need the financing for, right? Corporates don't work out their financing. They go to banks and ask them to help to do it. Why do humanitarian or development organizations, right, operating in the field think they're best placed to work out the solutions? They're not. They need to articulate the operating need, okay, and then and then ask a financing house, institution, organization to help them solve that. And financing institutions and development actors need to get a lot more sensible and pragmatic and recognize that AB loans and blended finance and stuff, work very well in stable environments where rule of law and there's functioning institutions. We don't have solutions, we don't have tools yet well developed that work in a humanitarian or fragile, conflict or violence setting where these institutions are. And in order to achieve the SDGs, we need to do that. So it's a development problem.
Well, Michael, I want to come to you because at MedAccess, you guys are using some sort of innovative financing tools in interesting ways and using public monies that you raise in a way to sort of get to scale on certain things to unlock certain new innovations and developments, particularly in the sort of health space, right? So tell us a little bit about some of those tools and how can you look at the tools that MedAccess is using? Are there other applications? Can we use, some of the things that you're learning and apply them in different contexts?
Thanks very much, Adva. So MedAccess is a company that was founded by British International Investment, the UK Development Finance Institution. We're a subsidiary of BII. We have $200 million of paid-in capital that we use for financial transactions relating to access to medicines. And what we saw in the last session, we discussed pandemic preparedness. We saw during the COVID, the world was divided into the haves and the have-nots in terms of access to vaccines. And we saw it really starkly with COVID vaccines. But in fact, that situation of people being divided into those who can get access to medicines and those who can't pervades all sorts of areas all the time. And in fact, there's a ongoing, persistent problem of people really needing essential medicines that are available. We have the science, we have the technology, but they just can't get them. They can't afford them, or they're not distributed, or not approved in their country, or whatever. On the other side, businesses have these great products, often developed by the best of science and manufacturing, and they often can't take on the market risks of distributing them or getting them into countries which are perceived to be much higher risk. So that's why MedAccess was set up. We partner with businesses to help them de-risk bringing their products to what they perceive to be riskier markets. So larger volumes, newer products brought to market faster, brought into new countries.
Can you give us a tangible example?
Yeah. So I'll give you we've done a number of them, but we worked with a company called SD Biosensor based in South Korea. They developed a test, a rapid diagnostic test that would test for HIV and syphilis for pregnant women. And that test has been around for some time, but it was way more expensive than the test which is just HIV alone. And so around the world, women are tested for HIV when they're pregnant to see if they're going to pass it on to their kids, right? But they're not tested for syphilis. And syphilis is a horrible disease that's also passed on to kids, also causes stillbirth. And we partnered with this company to help them bring down their price so they could produce a test at a price that was lower than the prevailing HIV test. And the way they did that was we helped them guarantee substantially increased volumes of sales across many, many countries simultaneously. And we provided them with what we call a volume guarantee, which is we said, well, we think, we've done some demand projections. We think you can sell all this stuff in these various countries. Here's what would have to happen. And if you don't do it, we will make you whole. We will make a payment. And therefore, it's worth you as a company taking on the risks of increasing your manufacturing volumes. It's worth you as a company taking on the risks of bringing marketing teams into new jurisdictions you've never worked before. Because we're there as a safety net. If it goes wrong for you as a business, we will be there to make it okay. And that allows, and when we do these deals, they cover many, many countries at once. We prefer to do more than a dozen countries at a time. And we have seen really substantial price reductions and really accelerated access to products. So I'm not going to go through all the products, but they include, for example, the new next generation mosquito bed net that has 2 insecticides in it rather than 1. We partnered with the German company BASF so they could reduce their price by 40%. Without the guarantee, they couldn't have done that. And it's now being used very widely in malaria, where there's a mosquito resistance. We've done HIV tests. We helped support the world's first malaria vaccine coming to market, a range of products. Yeah. But the key thing, in terms of tools, so we mainly do guarantees. We can also provide credit and working capital to help companies increase their production. But the key thing really is what we provide is, in that really risky world I was talking about earlier, about there's lots of uncertainty, we help to de-risk the market for companies. And if you're a manufacturing company, it's pretty easy, it's not impossible, to get equity and debt and working capital to invest in the supply of ramping up production. That's fairly easy to finance. What's almost impossible to finance is thinking about de-risking the demand side. You just have to take all the risks yourself as a business. And I think what MedAccess was founded on was the premise that if we can help de-risk that, we can help businesses get products out more cheaply, faster, better, improve access for patients. So that's what we do.
So we're actually going to come to the audience for a few questions in just a minute. So think of your questions, because I'm going to take them in a minute. But I want to talk a little bit more about guarantees, because I think it's something that has been discussed for several years as, we need to see an increase in volume of guarantees to help do that de-risking work and bring more of that commercial capital in. And I don't know that we have seen a particularly rapid growth of the use of guarantees among DFIs, MDBs, et cetera, different actors. And so I wonder, do you think we need more guarantees? And then how do you get there? How do you, if that is a mechanism that can help bridge that gap, why aren't we seeing more of it?
You want to say?
Yeah. Sure. Or
All right, maybe I'll a few things on that. We are looking at for the GOMA project. We're also considering a guarantee that may come from one of our European partners to support the private operator further down the road. What I would like to underline is that the model and the mechanism you are going to use depend on the problem you are trying to solve. As Simon was referring before, impact bonds were all the rage, so I think we settled that one. Our side, what we're looking at is at a series of families of mechanisms that we are applying to a series of projects that have been launched or are in development. That includes outcomes-based financing. That includes, blended finance, concessional finance type of approaches. We're looking at debt conversion. We launched the ICRC Climate and Environment Transition Fund. We're also looking at crisis risk financing. That's farther behind. So these mechanisms respond to the problems we are trying to solve. And maybe just one more point is that in our experience, what has been instrumental to us being able to do these things is the fact that we have brought into the organization people with financial expertise in the public and private sector, because doing this requires a lot of interpreting and translating and building bridges between institutions. One other action that has been extremely useful for the ICRC is to bring somebody with 30 years of World Bank experience into the ICRC at a very senior position. And lower levels, people from AFD, the Agence Française de Développement, for example, into the ICRC, and ICRC people into the AFD. And this builds understanding, bridges, and actually puts projects on the table that can then be implemented.
Yeah, just echo what Juan said. I can only endorse that. I mean, it's not about products, okay? It's not about, it's about solutions, right? And what people need to focus on, I mean, what Juan has said is absolutely worth reiterating, but it shouldn't be. It's obvious, right? I'm a financier. I can help with finance. The worst thing you could do is send me to the field and come up with a wash solution, right? Or whatever. I mean, these are, right? So why is it acceptable in these kind of environments for field operatives or people with long and deep industrial, experience of sector expertise to start on innovative finance? One of my favorite questions, and if you approach me, I'll ask you, when people say, I work in innovative finance, I'm like, oh, great, what's your finance experience? Typically, it's zero. And I'm like, well, you're not going to work out the solution in the same way, and that's not to denigrate what you're saying, is, I'm not going to work out the best wash solution, right? Or the best, community engagement solution, because that's not my knowledge or expertise. So I think it's really important. Don't focus on the products. Yeah, exactly. You bring in expertise to help you work through those things.
Oh, I'd love to have a chance to disagree, and you've just given me a chance.
Great.
So, look, I think that you asked about why we're not using more guarantees. It's absolutely critical. You do have to have the finance expertise in-house. And in MedAccess, we have a team all come with lots, black belts in finance all out of the city. We've also got a team of people who have tons of public health experience. But the key thing that we have is people who are really, really good at doing market analytics, of understanding what is the market, what's the demand going to be for this range of products. And those people, with the finance folks, actually do have to get in the field. And the reason why they're able to assess the risks on our guarantees is precisely because they get information out of the field that if you're just sitting in the city trying to value a guarantee from afar, you couldn't have that information.
We don't disagree at all. Totally. I mean, it's not.
Oh, man. It's a lot less interesting.
God knows, more white finance people from the City of London is not the solution, right? As someone who's white from the City of London. Absolutely, it's a combination, right? And people need to kind of bring their expertise into the debate, 100%. And I think what people need to do, like MedAccess, and it's a brilliant example, so, I vehemently agree with Michael, is it's articulating that investment case, right? And then saying, and then the finance people or the finance sector and a combination will say, well, a guarantee is appropriate or another thing. And that investment case is not just the hard finance. I mean, because of the rise of ESG and people are aware, and corporates and private sector, and it's great to see so many people here, are interested in social goals and how is that demonstrated and how is that articulated, not just because of marketing, but because it's the right thing to do increasingly. And that's part of making that case, right? Making that, and also that doing this makes, to governance is more effective, is more efficient. And one last thing, I'll do a shout out. I mean, you can also say, in the space of guarantees, insurance. right, can be super useful using. I mean, you see that in export credit. That's, insurance is done, or lots of other contexts. I mean, we're working on a project with, around insurance as well for emergency response. So
I think what's interesting in what we do, there were a number of insurance and reinsurance companies who kind of looked at it. Could we provide that kind of, and what they found impossible to do really was to quantify the risks they were taking. And that's because they didn't have enough information. So what is essential for us, it's just for us, is understanding what is the real demand in country. And that means not, are people going to use these products? That's not just talking to the Ministry of Health and the officials of the Ministry of Health, but understanding at the community level, what are people really going to want this stuff? Are they actually going to use it? And that means, we were in the previous session talking about CSOs and connecting with communities. There's an essential bridge here between, high-level smart finance and community use and the way communities appropriate and respond to their problems. Only by bridging that, really, can we make the smart finance work.
Yeah. Absolutely. So I want to take just a couple questions from the audience if we have questions. I think we have someone with a mic who's going to, now I can see you guys all a lot better. Let's start here.
Thank you. My name is Carlotta Chialastri. I'm the partnership lead at Lightful. Thank you so much for this discussion, and it's great to see the inclusion of private and public sector together, but I want to bring another layer, which is the CSO, and we say that it's very important for CSO to be part of these, but still the problem of funding for local civil society, local NGOs is huge. Think of Ukraine, 0.003% of all the funding, appeal funding, has been channeled to local civil society. Now, what's the role of innovative financing? If there is, what are the barriers for local civil society, local NGOs to participate in this discussion to be able to access this same innovative financing? Thank you.
And then we'll take a couple more questions. We'll come here.
Hi, my name is Sasha Gayama. I'm the head of alternative financing at the Danish Refugee Council, so I look forward to speaking to you later, hopefully. A comment and a question. I think comment-wise, fully resonate what you said. What you said about impact bonds fully resonates with me. Clearly, I think scale is the wrong question. For me, it's more a question of quality of money. What kind of money do we need? We've been banging on the table with different types of funders. We need longer, more flexible, and whether impact bonds are one of the ways of testing those use cases is, well, one way or the other doesn't matter. But that for me is the real question, like quality of finance. So to that point, the question here is are you confronted, as I feel I'm confronted with this chicken and egg situation of we want to start with the problem, as Juan says, but a lot of the time just getting those high ambition, integrated, partnerships that address multiple issues, it's just hard to get off the initial ground because people are time poor and clearly when it comes to CSOs, money poor as well, so you can't get them around the table with some fictional idea that doesn't meet their immediate needs, and that sort of is a chicken and egg question that prevents the kind of finance that we need from actually materializing. So that's, for me, a bigger part of the work that I do, but I'd be curious to hear how you address it. Thank you.
And let's take a question here.
Hi, hello, my name is Olga Artu. I'm representing Food and Land Use Coalition at World Resources Institute, and I'm operations manager. We do work in African countries. We do have a Follow Ethiopia country platform. And I have a question about blended finance because many things said are very resonating. I used to work with blended finance at EBRD, and obviously blended finance in emerging Europe had a great success. In Croatia, in Georgia, and then you go back further to Central Asia. So there is a certain need for a market-level development for blended finance instruments to work the way they can be successful. Now, it's, for example, now a big, and because it was clear that blended finance instruments in certain conditions can produce very good results, it's now natural appetite in least developed countries for those developed the blended finance instruments. For example, in Follow Ethiopia, we're working with the Ethiopian government who clearly shows the big interest in blended finance instruments. Yeah. But then this big question of exactly what happens if the state is in fragile. Yeah, it's large war now in Ethiopia. So, how can we take the discussion on blended finance further to understand when it's the time for the country to start implement blended finance facilities? Because obviously there has to be a threshold in them as we know them now.
So we have 3 questions, and maybe you guys want to just answer what sort of speaks to you. So we have one question about how to better involve CSOs in some of these conversations, and perhaps particularly in ensuring that you have the kind of market information, for lack of a better way to refer to it. A question on how do you actually practically build these high impact partnerships and bring together these different forms of financing, and one on how do you figure out the right time and the right type of blended finance instruments, particularly in more fragile or volatile countries.
Shall we take it from the right?
Sure.
All right. Okay. So a few things my side. We are the founding member of the Red Cross movement. Every country has a Red Cross. They have hundreds of thousands, actually millions of volunteers across the world. So from that aspect, the work of the Red Cross is very based also on the national Red Cross. So we work very closely with them. The debt conversion mechanism that we're working on would be oriented toward mobilizing additional resources for national societies in African countries to deliver on humanitarian impact. In the case of the Goma West water supply project that I was speaking about, Michael, you were speaking about the role of communities, has been named a number of times. It's of course critical. I mean, the ICRC does have boots on the ground, but we're also working with the Congolese Red Cross to better understand how water works within the community. So that's on that point. I think Sasha was also asking about financial additionality of these mechanisms. Is that correct? No? Okay. All right, then I'll come back to the question of how do you build these partnerships? Well, it takes time, it takes trust, it takes long-term relationship, but also it takes putting ideas on the table. One key lesson from our side is that if you want to do innovative finance, then do it. We started with the humanitarian impact bond. Again, it's not hugely replicable, but we learned a lot, and it was a very successful transaction, and that delivered the humanitarian results we expected. So just keep trying things, but you need leadership engagement, you need organizational engagement, you need organizational readiness, you need expertise within the house, etc., etc. So it's not for the faint-hearted. I would put it that way. But again, this is about what is your role within a bigger financial transaction. One example or two is in Jordan with the EBRD, by the way. The International Rescue Committee is part of a 50 million project, but their part is a small part, but it's precisely based on engaging with communities for that given project. That enables the project. Right. So that is also part of the way you should be looking at things. And maybe just to end from my side, when it comes to the blended finance side of things, the way we're looking at it is, what is it that we can bring to the table in terms of boots on the ground, understanding of the context, relations with everybody and their mother on the ground, technical expertise. What is it that we can bring to bear so that a project that would not be viable because too risky can actually become doable? When you ask Munich Re, for example, why they did the humanitarian impact bond with us, is because it was the ICRC and because we had the data.
Yeah. Great. Well, we are very short on time, but I'll give the two of you is there one last thing you want to say? I'll but otherwise.
One, I think absolutely impact bonds have lots of advantages, but the size isn't one, right? So two, I think, as you said, I mean, this is complicated, and what we need to do is if you need a small amount of money, you go to a bank. If you need a large amount of money, you go to the bond market and you get advisors and things. I mean, to give you an idea, Citibank, people will know, were very involved in COVAX and made it happen, right? They staffed 50 people on that. Okay, so don't be surprised that getting a bunch of people together and workshopping something in the afternoon hasn't changed the world. It won't, okay? But that's okay. This is really hard. If it was easy, it would have been done already. But we need to be much more ambitious, as a community, but and recognize it's much harder work. You know, it's the Edison quote, like it takes a long time to be an overnight success, right? And you know, I think any of us will kind of bear that in mind. So.
Well, I think then you've brought us full circle, Simon, because you started by saying that we need to have more bold, radical thinking. So I think you've brought us back to that point at the end. And I want to just thank the three of you so much for this great conversation, and I'm sure you guys can have more of an opportunity to talk with them throughout the day. So thank you so much for being here and being with us.